This week we'll be finding out about more robust ways to make investment decisions. That with our special guest joining us from Cape Town, Linda Eedes, a senior analyst at RCM, and joining us at the desk here, Cobie Legrange, strategist at ClucasGray Investment Managers, and Roland, Rousseau, equity strategist from ABSA Capital. Welcome to you all. And Linda, I'll throw straight to you because we have been talking about the folly when it comes to forecasting and the fact that there's that analyst forecast error, especially the further out you look at their forecast. So, I mean, we looked at, analyst forecasts around GDP growth and how wrong it can be. So when you're looking at that with a pinch of salt, perhaps when you're looking at how to invest in certain companies and you take forecasts with this, it's kind of sense of pessimism, what would you be looking at then to define a quality company to invest in?
Thanks, Samantha. Well, there's two sorts of forecasting which we think are probably not such a good use of your time. And that's, first of all, macroeconomic forecasts. And as you rightly point out, first of all, it's impossible to do it consistently and correctly over time. So you might get it right every now and then, but that's probably more luck than skill, and you can't repeat it. But secondly, macroeconomic forecasts don't actually correlate very strongly with investment returns going forward. So, in other words, areas of good economic growth don't actually necessarily produce the best investment returns. So it's actually sort of not really a good starting point. And then forecasting on revenue for individual businesses is also something that's very difficult to do accurately over 1 year even, and certainly even more difficult as you go out. So what other options are available to you? Well, we know that we're investing for the future and we don't know what's going to happen in the future, and we sort of have to accept that and say, well, what else can you do? As value investors at RCM, we believe that your best protection against negative events in the future is to buy high quality businesses when they're extraordinarily cheap. So from the bottom up, to buy businesses when the prices are very low.
Mm-hmm. So how do you define a quality business? I mean, what are the issues that you'd look at, or what are the metrics you'd look at to ensure that you're investing in quality?
That's also a very important point, because sometimes our perceptions of quality actually differ over time. Because when a share price does very well, we think a business is great and it's high quality. And that very same business, when the share price disappoints, we think all of a sudden that the business isn't high quality. And a share price performance and business performance are two very separate things. So what do we mean by quality? We mean businesses which have a demonstrable track record of earning returns over and above their cost of capital over time, and very importantly that they've got a barrier to entry which remains into the future, which suggests that that will be the case going forward as it was in the past. So those are really our sort of definitions of quality at RCM.
That's and if you look at that definition, I mean, that if you speak to any of kind of the large value managers globally, they would have nuances of what Linda has now explained. And I think this is the important thing also for investors, is that if you're not necessarily just going to use forecasting, you have to have this ability to understand what quality is and why quality is important, and how and why you're defining quality in a certain way. If you're looking at businesses that are more of a mid and small cap type of size, your definition of quality might be slightly different to maybe buying a large cap business. And it just takes a little bit of time maybe to kind of bend your head around. I mean, Linda, one of the things that you guys talk about is the quality that you saw in a counter such as Microsoft. And you'll see it on your screen right now, and you'll see the share price of Microsoft over time. You've, as RCM, actually got involved in Microsoft as a shareholder. Just take us a little bit through, just apply your quality criteria quickly to Microsoft for us.
Well, it's very interesting because Microsoft is a very high quality business. I mean, they have got very permanent barriers to entry. We all use their products. They have a very entrenched network, and even free alternatives haven't really been able to tempt most of their customers away from their product suite. So Microsoft has always been a quality business. It's actually always delivered fairly good fundamental returns, but the share price has gone from delivering fantastic returns in the run-up to the tech boom, and then in the bust it fell dramatically, and since then it's sort of been fairly even, and then recently had a bit of a re-rating. But the perception of Microsoft as a quality business has changed over time, depending on how the share price has moved, and we think that's obviously incorrect. Now, we invested in Microsoft in mid-2011, and at the time we said the share price is low, this is still a quality business. And one of the misconceptions about value investors is that we don't invest in growth businesses. Now, Microsoft clearly being sort of more on the IT side typically tends to be more about growing your revenue over time. And the question is, what were the assumptions that we used to get to the value that we believe Microsoft should trade at? Well, they weren't very aggressive assumptions, and I think a lot of people say to us, Microsoft, they're never going to replicate their history. You know, they had 20% plus revenue growth in their early years. Surely that's a thing of the past. And we would totally agree. Yes, it is. It's a mature business now. But the assumption that we put on its growth is that it will be able to grow at least, given these barriers to entry, with world GDP. So that's around 4% per year. Now, if you looked at what the market was assuming at the time that we bought it, it was telling you that the growth of Microsoft was going to be negative into perpetuity. So this is a declining terminal business. And quite frankly, we obviously disagreed with that for good reason. We bought it, and the share price has done fairly well since then, but we think there is further upside based on our assumption of merely world GDP growth.
Mm-hmm. Another way to look at risk is also to assume that if you've got a quality company with quality management, they're going to be able to manage the company through cycles, they're going to be able to make the right decisions when it comes to allocation of capital. I mean, what are your thoughts on that?
Well, we always assume that it's obvious what quality is, but it's actually very often only possible to know a quality business in hindsight. Mm-hmm. So there's definitely risk around this. I mean, you could think of a company like Enron, which was for many years seen as a very high quality company, and look what happened. Now that's a fraudulent example, but another example would be Kodak. Kodak had big revenue, big staff, they went bust. Apple, is Apple a quality company? Well, it might have been, it might not be going forward. We don't know this. This is why it's risky to invest on this basis. But you know, if you don't take risk, you're not going to get the returns.
Yeah.
Yeah, and I think it comes back to what Linda said a little bit earlier on, and it's understand what you don't know. There's some risks that you just don't know. If you know that the future is uncertain, and you're going into investing with that as a caveat to your investing activity, then quite frankly, you need to make the best decisions with the information that is actually available available to you at a certain point in time. And I mean, Linda, one of the big things here, obviously, is your experience with something like a Linic bottling company. Do you maybe want to just take us through that purchase and how that happened?
Well, that's a great example of where if you were a macroeconomic forecaster, you wouldn't have even looked in that area because that business is listed in Greece. So if you were trying to say, well, where's economic growth going to come from, your starting point would certainly not be in Europe, let alone Greece, when we started investing in that business, which was also sort of towards the beginning of 2012. Now, that business is actually an international business. Its revenues come from various parts of the world, including Nigeria and Russia, Romania. It happens to be listed in Greece because it was owned by a Cypriot family to start with. It was sold down by the market because it was listed in Greece. As a result, the share price was extremely cheap, and we could see that this was a quality business through its history, that it had delivered that excess return over cost of capital, and so we bought. Now, that's the benefit of a bottom-up investment process which merely looks at price relative to value, as opposed to a top-down investment process which starts with forecasting, which we know is very difficult to do and which we know is a really bad starting point because you're probably more likely to be wrong than right. And that share price did incredibly well. I mean, that stock is up, sort of more than 50% in US dollar terms since we bought it. And really the macroeconomic situation in Europe and Greece hasn't changed that much. But when you buy stocks which are cheap, good things tend to happen.
It hasn't been also the best of time, though, for value investors. And Roland, you, of course, want to point out some of the challenges, and perhaps we'll also get some comments from Linda going forward in terms of how she sees the space shaping up for value investors.
Look, generally, most research globally shows that value investing is definitely something you want to do, but it is a long-term kind of game. So the risk with value investing is that you are, as they say, wrong for long. And it is, I think Peter Lynch who said that the biggest challenge as a value investor is keeping your clients. If you can get through the bad patches, which could be 5 years, you will do well at some point, right? Now, for the last 3 years in South Africa, value investing has been challenging. It's been mainly large caps and sort of expensive companies like retailers and the SA breweries, which are sort of emerging market kind of companies that have done really well because of this quantitative easing kind of bias. So it's made it pretty challenging for value investors to do the right thing, even though they stick to their knitting. But hopefully at some point they will get that value risk premium coming through.
Overall, I mean, when do you see the tide turning for value investors as a whole here in South Africa, Linda? I mean, also your comments in terms of discussions you're having around, keeping to this specific strategy right now.
Well, the first thing I want to sort of point out is that actually value investing has done phenomenally well globally, and it's done very poorly over the recent past in South Africa. And that's the very same philosophy, just happens to be different things happening in the market. And it's very true to say that locally, in this part of the market, a late stage bull market in certain areas of the market, which Roland mentioned there, you forego some of the upside as a value investor because you are protecting your investors against that risk of permanent capital loss. The problem with the market that's been running is it does not tell you what risk controls are in place to protect your portfolio when that market stops running. You cannot tell whether the risk controls are there and they just haven't been needed yet, or they are totally absent. And a lot of, sort of performance that looked great just prior to the financial crisis came horribly unstuck when the market fell. And that's really when luck and skill becomes differentiated. So yes, in South Africa, we've had to forego some of the upside, but we're invested in the stuff which is cheap and which is most likely to give you the best investment returns from this point onwards. And in fact, we're very excited about the opportunities that we're seeing locally in the South African market today. More excited than we are about the global environment, which a year ago was the opposite way around.
Mm-hmm. You said you're sitting in a situation where those big rand hedge stocks, the valuations are just going up and up and up and up and up, and you've got many other stocks that are just holding back on the valuations. And it's as if that kind of disparity between the two are just getting greater and greater and greater, and at some point they close.
Well,
it has to happen.
Some would argue that we have started to see a slight shift in sentiment as of late. We'll have to leave it at that for today. Thank you so much. That's it for this edition of Wealth Quest. Please do keep those emails coming to the address up on your screen right now. Give us your feedback, send us your comments, send us any suggestions for topics that we can discuss here on Wealth Quest. You can also go to www.abndigital.com, that for our past shows and Cobie's blog. Stay tuned to CNBC Africa as Karima Brown unpacking the latest in South Africa's political economy. From myself, Samantha Loring, Cobie, Roland, and of course Linda Eedes in Cape Town, it's goodbye.